With the worldwide Easter holiday this weekend, the markets did not open on Friday. However, here are just a few highlights from key markets around the world till Thursday, April 6. Let's look at Europe. Euro Stoxx 600 closed up 458.94, up by 0.51% at the end of trading on Thursday, snapping a three-day losing streak. At the close of the markets in Frankfurt, also on Thursday, the DAX rose 0.5%. France stocks were also higher at the end of the last day of trading on Thursday. In Paris, the CAC 40 gained 0.12%, and in London, the FTSE 100 all-share index rose 1%, hitting its highest level in over 3 weeks and ending the holiday-shortened weekend about 1.4% higher. Now to Nigeria. In the trading week ended Thursday, April 6, the Nigeria Exchange Limited All-Share Index and equities market capitalization depreciated by 0.05% to close at 52,994.13 points and 28.869 trillion naira in market cap. Now for some top stories. U.S. multinational Johnson & Johnson has proposed a $9 billion settlement fund for talcum powder cancer lawsuits. Johnson & Johnson has faced several lawsuits related to cancer linked to their products. The lawsuits have alleged that the company's talc-based products, including baby powder, contain asbestos, and that using these products can increase the risk of developing cancer. Since 2018, the company has paid out over $5 billion in lawsuit settlements. The $9 billion settlement fund, which still needs to be approved by a bankruptcy judge, will cover over 60,000 claimants in the coming years. Richard Branson's satellite business unit, Virgin Orbit, has filed for Chapter 11 bankruptcy protection in the U.S. The filing, which was made on Tuesday, was prompted by the company's inability to secure long-term funding following a failed launch in January. This comes less than 2 years after Virgin Orbit went public at a valuation of roughly $3 billion. But the January rocket mishap left the company scrambling for new funding and forced it to halt operations. It is also seeking a sale of its assets in a Delaware court after announcing plans to lay off roughly 85% of its 750 employees. Virgin Orbit was valued at $65 million at the close of trading on Monday. However, on Tuesday, its shares shed 23% to close at a mere 15 cents each. All eyes are on the Swiss front as prosecutors probe the UBS Credit Suisse takeover deal amid plans to cut 30% of its workforce. Switzerland's top prosecutors opened a probe to gather information into potential crimes that may have taken place around UBS's takeover of Credit Suisse, while the emergency combination of the nation's two biggest banks begins to take shape. According to newspaper reports, the $3.3 billion deal signed last month may reduce the overall workforce by up to 30%, with as many as 11,000 cuts in Switzerland and another 25,000 worldwide. The Office of the Attorney General said it was working to gather information on numerous aspects linked to the takeover without specifying what it was looking for. Still on the Credit Suisse situation, the bank's chairman apologized to shareholders for taking the bank to the brink of bankruptcy. The hasty takeover bypassed Credit Suisse shareholders who would otherwise have had a say in its dealings. Alex Lehman issued an apology to nearly 2,000 shareholders in attendance at their final meeting, saying he had run out of time to turn the bank around despite his belief that it could survive. UK data privacy watchdog has fined social media app TikTok £12.7 million for misusing children's data. The Information Commissioner Office on Tuesday said it estimated that up to 1.4 million UK children aged under 13 had used the viral video app in 2020, even though TikTok's own rules forbid children younger than 13 from creating accounts. The platform had failed to gain parental consent to use children's data, contravening UK data protection laws, the regulator said. The fine adds to the regulatory onslaught from governments around the world to restrict or ban the app over national security concerns. TikTok has a right to appeal the fine within 28 days. On Wednesday, China called on the World Trade Organization for stronger monitoring of US-led chip export restrictions. Speaking at a WTO meeting in Japan, Chinese representatives urged the body to step up supervision of the Netherlands and US measures and plans to restrict chip exports to China, calling the move a violation of the fairness and transparency principles of the WTO. Last week, without specifying China as the target, Japan said it will restrict export of 23 types of semiconductor manufacturing equipment. Economic and political ties between Russia and China continue to grow as China's currency, the yuan, replaces the dollar as the most traded currency in Russia. According to reports and data compiled by Bloomberg from the Moscow Exchange, the yuan surpassed the US dollar in monthly trading volumes in February for the first time, and the margin increased in March. 1 year prior to the invasion of Ukraine, which led to a slew of Western sanctions against Moscow, the yuan trading volume on the Russian market was negligible. China's President Jinping also visited Moscow in March, promising expanded cooperation in trade, investments, supply chain, energy, and tech. China, of course, appears to be leveraging its trade advantages to promote the use of its currency with major commerce partners, building up the yuan's strength to challenge the US dollar's dominance in the international monetary system. There'll be more about this story actually later in the program, but let's review some stories from Nigeria. Reports have emerged that a peer-to-peer Bitcoin platform with over 1 million Nigerian users shut down. Co-founder and CEO of Paxful, Ray Youssef, disclosed in a blog post on Tuesday that operations would be shutting down with no return date in sight. Although cryptocurrency is banned in Nigeria, the 2020 Geography of Cryptocurrency report by Chain Analysis ranked Nigeria 8th in crypto adoption and usage among 154 countries included in the study. With over $1.5 billion volume traded since 2015 to date, Nigeria is the firm's largest market. The CEO did say that it was working through serious issues like key staff departures and regulatory problems. It had taken the most secure option and urged subscribers to explore self-custody and trade elsewhere. Nigerian President Muhammadu Buhari has sacked the Executive Secretary and CEO of the Nigeria Investment Promotion Commission, Hajiya Saratu Umar. In a directive to the Ministry of Industry, Trade and Investment, the president issued a release on Thursday evening ordering her immediate termination and mandating the most senior director in the commission to take over in the interim. Umar was reappointed NIPC Executive Secretary and CEO in July 2022 for another 5-year term by the president. The Nigeria Bureau of Statistics has revealed that the Nigeria equities market attracted $19.2 billion investment over the last 5 years. The figure represents 31.2% of $61.46 billion total capital importation into the country in the period under review. 2022 recorded the highest decline in foreign direct investment, followed by 2021, attributed to domestic economic challenges such as scarcity of FX and political uncertainty. Also in 2022, the stock market attracted $469.42 million out of a total of $5.3 billion in capital inflows, a decline of about 57.08% when compared to the $1.09 billion inflow into the stock market in 2021. Foreign portfolio inflows into the stock market stood at $1.86 billion in 2020, contributing about 19.1% of capital inflows, and those figures stood at $5.3 billion and $10.4 billion in 2019 and 2018 respectively. Nigeria recorded the highest jump in oil production in March among OPEC producers at about 1.6 million barrels a day, a Reuters-conducted survey disclosed. Nigeria's oil output, as published by the Nigerian Upstream Petroleum Regulatory Commission, NUPRC, was 1.25 million barrels a day in January and 1.3 million barrels a day in February. But the volume produced for March came close to 1.6 million barrels. The latest production performance contributed significantly to the 28.9 million barrel a day pumped by OPEC, allowing the country to meet the federal government's target for the first quarter of 2023. And still on Nigeria and its role in OPEC, oil jumps 8% after OPEC Plus jolted markets with surprise output cuts. The OPEC, Organization for Petroleum Exporting Countries and Allies, including Russia, a group known as OPEC Plus, shook markets with Sunday's announcement that it will lower its production target by a further 1.16 million barrels a day. This raised fears of tightening supplies, while some warned of reduced demand if oil refiners flinch at paying higher prices for crude. Brent crude settled higher by $5 at $84.93 a barrel after touching its highest since March 7 at $86.4 a barrel. West Texas Intermediate crude settled up by $4 at $80.42 a barrel after rising to a two-month high during the session. The latest pledges bring the total volume of cuts by OPEC Plus to 3.6 million barrels a day. And finally, the World Bank Group and the International Monetary Fund will host their annual spring meetings in Washington, D.C. from April 10 to April 14. These yearly events are a combination of official closed-door meetings amongst World Bank and IMF leadership and public seminars on global economic development, as well as high-level events featuring prominent officials. This year's theme is titled The Way Forward: Building Resilience and Reshaping Development. Key issues expected to shape the agenda, including international trade and technology and global financial and banking sector stability, expected to be hotly debated. Well, that's it for the market roundup. After the break, market and financial analyst Bode Oshosami joins me to review some of these stories. Do stay tuned. Welcome back to Business Week on Arise News. Joining me now to review some of this week's business highlights is market and financial analyst and anchor of Global Business Reads on Arise News, Bode Oshosami. Thanks for joining me, Bode. Good to have you this morning on the program.
Good morning, Rolake.
Good morning. So we want to start with the OPEC story. Oil has jumped 8%. That is quite the jump after this surprise cut by OPEC's Plus. What exactly is this move intended to achieve?
Well, at the OPEC technical meeting, the 1.66 million barrels per day voluntary cuts by the 9 countries led by Saudi Arabia and Russia were confirmed. And obviously, OPEC Plus wants a higher floor on the oil price. And they said reductions were a precautionary measure to stabilize the market. It was a reaction, I think, to the trend of decline in crude prices in the first quarter, with China yet to provide stronger support to prices. Central banks tightening still going on, and the banking woes stoking potential demand destruction. It puts OPEC back in the driver's seat and is a gift to Putin, who wants an extra $10 per barrel. But it also sends a message that OPEC members are ready to be more flexible outside the broader OPEC strategy. Another message that this confirms is that fears about demand concerns and that the analytics do not quite see a strong economic rebound in 2023. And the OPEC members are also bolder to call the bluff of the U.S. not pleased with past cuts. The wider implications on global inflation and the economy will be unbearable in the present context, but I think we should watch the compliance on these voluntary cuts first before coming to conclusions on whether this will lead to stagflation. I don't see $100 Brent, as many are quick to speculate. Initially, oil prices, as expected, soared at the start of the week as the cuts shocked markets, but prices have since been capped by growing fears of demand destruction due to still tepid economic growth, tightening, and the uncertain recovery. On average, I see Brent still in the $75 to $85 range, with the occasional spike above and below that range.
Yeah, interesting point there about the impact on inflation. And I'm glad you brought in the U.S. because historically these moves by OPEC or OPEC Plus have not been received warmly in the U.S., especially around the pump price of fuel in that market. What do you think any immediate reactions from the U.S. government might be with regards to this move? Do we see the possibility of a release of strategic reserves, or do we just not know for now and need to wait to observe?
Well, the Biden administration had planned to buy back oil for its strategic reserve, petroleum reserve, when prices fell to about $67 to $72 per barrel. The reserve have really been significantly depleted. But Energy Secretary Jennifer Granholm, she said recently that would be difficult to do this year. Also, the US had threatened Saudi Arabia when they made the first cut, remember the earlier meeting, but they didn't back these threats with actions. So my sense is, obviously, Biden is not going to have oil prices going up. He has said he's going to protect gasoline prices in the domestic markets, even though the reserves are pretty much aggressively been depleted. There may be more of that, releasing more strategic reserves, at least in the near term. The other thing, of course, is Europe is facing a situation where they're having to buy even more expensive energy from the US. They cannot afford higher oil prices at this point in time. So like I said, I would wait to see the compliance, the impact of this, and how it develops. But definitely everyone is alert to the possibilities. But prices have somewhat come down after the initial panic.
Yes, indeed. And interestingly, Nigeria records its highest jump in March amongst OPEC producers. I mean, this stands interestingly somewhat in contrast to the recent move by OPEC, but I guess Nigeria has been battling its own production challenges. Do you think its production jump will have any impact on what is happening globally at the OPEC level? And also, what are the implications for Nigeria's own production going forward? Is this going to be a stable trajectory for output domestically?
Well, the voluntary production cuts help Nigeria to get a $10 per barrel fiscal boost, given it budgeted $75 per barrel. But arresting the decline in the oil sector definitely is more important than OPEC drama for Nigeria. Let me just give you a little background. In 1979, Nigeria oil production peaked at 2.4 million barrels per day. Nigeria production dropped to 1.6 million barrels per day in the mid-1980s as a dip in oil prices, OPEC quotas to correct oversupply, and higher tax regimes discouraged new investments. In 1986, the government responded with the first memorandum of understanding guaranteeing better margins. In 2001, Nigeria was producing 2.3 million barrels per day, and based on the forecasts I remember then, Nigeria was targeting 3 million barrels per day production capacity by 2003 and 4 million barrels per day by 2010. We don't have time to go over all that has happened in the last 20 years, but the story today is vastly different. Last week, the World Bank said Nigeria's oil production remains subdued, despite rallying to over 1.6 million barrels per day recently, putting growth at risk. So how Rolake did Nigeria, that was easily producing over 2 million barrels a day and envisioning 4 million barrels per day, how are they now struggling to do 1.6 million barrels per day decades after? So what went wrong? We can't blame OPEC, of course. I think there's a lot on the plate for the incoming administration. Nigeria is now dealing with crude oil theft, needs to revive and deregulate a comatose downstream, build a refining capacity, needs to improve economics of the basins to attract more investment in the more competitive environment. There are challenges with community relations. There is need to address divestment of IOCs. There is need to maximize local value add. There is need for effective models to fund the growth of gas exploration and production. There is need to accelerate the privatization of NIPC to unleash all the potential there and enhance overall efficiency. So quite a bit to do. OPEC for Nigeria, in my view, is a distraction.
Yes, indeed. And it's quite astonishing when you juxtapose where we are today against what we were doing back, 20, 30, 40 years ago. Let's see how that pans out. Well, Credit Suisse, of course, still in the news. Shareholders extremely angry at the CEO for bringing down a Swiss bank that is an icon. And there's now talk of job cuts. I mean, it's really just more and more pain before medicine. What exactly is this apology by the board really going to do? I mean, it's a little too late.
Well, indeed, a little too late. For the broader banking sector, analysts say instead of the sudden major collapse we saw in the 2008 crisis, we could be seeing a series of spouts of corporate consolidation, takeovers, and these types of situations with the more vulnerable models like Credit Suisse coming under pressure. The asset management giants with fortress balance sheets are set to do better, the JP Morgans, and those with lower cost of funds and the major lenders also will benefit from rate hikes. Both Credit Suisse and UBS, interestingly, had their board meetings last week. For Credit Suisse, it was apologies and excuses, but it came, in my view, a bit too late. What was most astonishing, especially in Credit Suisse for the shareholders, that on March 14, I'm talking about March 14, which was barely 2 weeks before the takeover, the letter to Credit Suisse shareholders read, "Dear shareholder, we are on a clearly defined path to set Credit Suisse up for sustainable success and will continue to be absolutely focused on the execution of our comprehensive strategic and cultural transformation," signed by Axel P. Lehman, the chairman. Then on the 29th of March, Credit Suisse was singing a much different tune, announcing a merger and rescue plan. So this is just unbelievable, especially for the shareholders. And it just shows that the communications were not there. A lot of the signals of what was wrong was not adequately either understood or managed. And I think a proper review of what really happened should be demanded. Indeed, there's an investigation that is going on. There was, of course, the Swiss approach was very, very polite. The shareholders, as usual, just took it. But I still suspect if there is going to be any way of scuttling this merger, if the shareholders can find a way of doing so, they certainly will. Of course, the push is coming from regulators to protect the depositors in Credit Suisse. UBS chairman, in their own meeting, of course, was touting the advantages and the results, what this would produce, and that is a much stronger bank. But there's still major execution risk involved, which perhaps explains why the risk ratings for UBS immediately went down after the announcement. And of course, investors and shareholders are not so happy about that. The elephant in the room may continue to be the ongoing Swiss authorities investigation until we get details. And let's see what the new UBS CEO, Sergio Morti, will be able to do. But this is a staff cuts about to happen.
Yes, indeed. I mean, as to be expected with any type of acquisition and merger, there probably will be some workforce cuts, but that may actually cause further controversy given what has happened. Thanks for your views on that. We have some time to talk about this TikTok story. Fined $12.7 million by the UK data privacy watchdog. Accusations of allowing underage children to download the app and so on and so forth. It's a major onslaught here. Is this more political, giving TikTok's roots in China? What are your thoughts?
Well, broadly, the tensions between regulators and developers, I think, are healthy, although in this case it's complicated by the geoeconomic conflicts between China and the US. Also, the existing tools available to regulators may not be adequate to achieve their consumer protection objectives in the new high-tech environment and investment in expanding. So there's need for investment to expand the regulatory capacity. So they are somewhat paranoid, I would say, given the limitations they may be having in the new environment. But of course, in the case of TikTok is a bit different from what we are seeing in artificial intelligence. In the case of TikTok, it looks like the end has been predetermined. There's a pre-known conclusion that TikTok will be banned, and certainly it looks more political to me than based on real tangible issues. With AI, however, it seems the whole idea is to start the required dialogue and OpenAI has not responded to regulators since last weekend's ban in Italy. Other AI platforms such as Google Bard might also be questioned. European countries are likely to follow suit with similar bans on AI chatbots. So we are going to get this continued trend in regulatory alertness, especially in the big tech plays. But to some extent, I think this is desirable to get the conversations ongoing.
Yes, indeed. And this Johnson & Johnson story, which is probably the last one we have time for in this segment, for as long as I remember, this company has been facing unending lawsuits. Is it really the end of Johnson & Johnson? And why can't they just get this issue with their products right? What are the implications of these?
Well, it's a difficult issue. Of course, you know that Johnson & Johnson insist that they are innocent and their products cannot in any way be associated with cancer, and the allegations lack any scientific merit. So they want this story to go away, and they are putting out billions, almost 9 billion, to blow the smoke off. I understand as many as 70,000 tile cancer victims with some law firms have already said, yes, they will take the bait. Senate and House Democrats say J&J, they want to deny people their day in court. You remember they offered 2 billion before? Now they've gone up to 9 billion. Will they even go higher, given they are desperate to move on? So let's see what happens. I'm not sure this will silence their Greek parties, especially if they see much larger punitive awards from the U.S. courts. And of course, the issue of LTL management, this is the company that was set up and has declared bankruptcy, is still a question mark, because regulators are saying J&J and LTL are neither bankrupt or in any financial distress. So quite a lot of issues here. But J&J stock was up over 7% over the week, and that's perhaps another sign that maybe this is going to work after all.
Yeah, an iconic brand, but facing some pretty serious reputational risks over this issue. Thank you so much for joining us on the program. We're still going to have you afterwards to talk about another big issue, de-dollarization, and its impact on the global business landscape. Stay tuned. We'll take a short break. Welcome back to Business Week here on Arise News. Last week, China and Brazil reached an agreement to settle trades in one another's currency. Over the past 15 years, China has replaced the US as the main trading partner of resource-rich Brazil, and as such, that shift may have been inevitable. But within the context of recent events, this appears to be another in a series of recent challenges to the central role of the dollar in global trade. As the world's reserve currency, the US dollar is essentially the default currency in international trade and a global unit of account. Because of that, every central bank, treasurer, exchequer, and major firm in the world keeps a large portion of their foreign exchange holdings in US dollars. And because holders of dollars seek returns on those balances, the ubiquity of dollars drives a substantial portion of demand for US government bonds, for instance. Now, the switch from dollars to a yuan real settlement basis in China-Brazil trade is only the latest in a growing trend. A conference in New Delhi, India last week focusing on increased cooperation between the BRIC nations, Brazil, Russia, India, China, and South Africa, touched on potential scenarios for de-dollarization. Just how fast is this wave growing, and what are the implications for the global economy? Well, still with me to discuss this very important issue is Bode Oshosami, Arise business analyst. So welcome back again to you, Bode. What exactly is driving the de-dollarization trend, and how feasible is it really?
Well, the geopolitics certainly is the key thing, especially what we are seeing in the situation in Russia. Monetary complexities also have made the dollar less stable than like it used to be, and the different global repolarization that we're also seeing is causing many to question reserve currencies, also questioning the dollar as a default currency in international trade. The drivers of the de-dollarization have also heightened of late. According to the IMF, the dollar's share of global foreign exchange reserves fell below 59% in the final quarter in 2021. That's extending a two-decade decline. 25% of the shift out of dollars has been into the Chinese renminbi and 75% into other currencies. Like you say, China moved last week to one-based settlement in its business with Brazil. And the ability of the West to eject from the Society for Worldwide Interbank Financial Telecom System, that's SWIFT, countries, to eject countries like Iran and of recent Russia, is also leading more countries to have their contingencies in place. Russia launched two critical pieces of financial infrastructure. One was an independent national payment system that worked as a Russian alternative to payment platforms such as Visa and MasterCard. The other was a proprietary financial messaging system called, they're calling it the System for Transfer of Financial Messages, or SPFS. That's the Russian version of SWIFT. In December 2021, SPFS had only 38 foreign participants from 9 countries. As at last month, SPFS had over 399 users. Even Russian banks in Germany and Switzerland, the two most important financial hubs in Europe, have access to SPFS. And Russia is negotiating with China to join and use the system. The dollar also has been, of late, less stable, given all the monetary interventions of the Federal Reserve Bank. Of course, the expansionary response of the 2020 pandemic, the outbreak of inflation reaching 4-decade high, and the shift to tightening, all this took its toll on the stability of the dollar. But you have to remember that the dollar, US dollar, is still the de facto currency in many countries and offers the cheapest means to invest in risk-free US Treasury investments. In terms of feasibility, clearly, there is going to be a lot of execution risk. The big question is, what will replace the dollar?
Yeah, very, very good question. What will replace the dollar? Now, looking at the attempt to de-dollarize, if you look at global trade flows now, when you look at tech companies, tech investments, for instance, a lot of that obviously is happening in the US. China is trading quite a lot with Africa and other parts of the developing world, emerging markets. Do you see this potentially, if it really becomes a thing and becomes successful, shifting global trade flows further in favor of the global south? Or, what might that dynamic look like?
Well, indeed, the fact that many countries are trading more with China than with Russia means that it makes sense for them to have more of their reserves, foreign reserves, in the Russian currency. And that is a huge driver to the de-dollarization. But, of course, we have to understand that the reason why people keep money in the US dollar is because the US economy is still considered to be the most stable. Corporate governance in U.S. markets is still considered to be of the highest standard. And the U.S. has the deepest and most flexible financial markets, the most transparent corporate governance, and arguably the least amount of discrimination between domestic residents and foreigners. So for the world to trust and accept, say, the Chinese currency, that would force Beijing not just to present the same benefits to foreigners, but give up capital controls, which looks unlikely. But there's an interesting link to foreign trade that you mentioned. You would recall that if you look at where we are now, there are huge existing trade imbalances in terms of you have countries that have huge deficits and countries that have huge surpluses. And the major economies with huge trade surpluses like Germany and China must acquire foreign assets in exchange for their surpluses. And the US and other similar deficit economies are the only stable, mature economies that are both willing and able to allow foreigners unfettered access, that is easy inflow and exit, to the acquisition of local assets. So in principle, yes, surplus running economies can accumulate amounts in other advanced economies apart from the US, but few are large enough and safe enough to balance more than a tiny share of the world's accumulated trade surpluses. And of course, developing countries are struggling because of the risks.
Yes, indeed. And the US has never been a country to take any threats to its economic prowess or dominance lying down. In a scenario where a significant number of countries around the world decided to move to a de-dollarized configuration, do you see any specific counter moves, either economic or in terms of new policies or criteria around investing in the US that may emanate from the US in a bid to neutralize the effect or impact of de-dollarization? And if so, what might that look like?
Well, my suspicion, Rolake, is that the U.S. is confident that the dollarization claims are exaggerated, requiring little need to make fundamental changes to their policies or to slow down the ongoing decoupling with the East, which of course is driving the dollarization. But there are three things they can of course focus on. They can ease tensions with China, which is of course the second largest economy, and encourage China to use SWIFT rather than switching to the Russian alternative system, instead of pushing policies that could lead to financial decoupling with China. If China goes out of SWIFT for any reason, of course, that's going to create all kinds of opportunities for another currency or other currencies in that system. Also, they can reduce barriers to encouraging more Chinese and international firms to list on U.S. equity markets, which would incentivize China to support the stability of dollar-based global financial markets. The other thing that's important, Rolake, is that the U.S. Congress can empower the Development Finance Corporation, that's the U.S. Development Finance Institution, to do significantly more to emerge as a credible source of capital for emerging markets and lower and middle income countries. China and Russia have advanced their de-dollarization efforts through multilateral development institutions, and they're definitely giving more, spending more to support developing economies, and there is no way these economies are not going to put their currencies in these accounts of these countries. So the US can counter this by doing much more in development finance. Then, of course, countries and companies comply with U.S. sanctions because they want to retain access to U.S. markets. So a strong U.S. economy is the most effective and credible tool for countering adversaries seeking to undermine confidence in the dollar. And the U.S. can move to strengthen its economy and be more sensitive to the costs of the economic warfare it is waging.
Yes, indeed. And, we've talked a lot about the US, Russia, and some of the other bigger emerging markets. But there's a question of back here in Africa. And, this raises a really interesting question of whether African countries should not be considering their own reserve currencies outside the yuan and the dollar. We've heard, over the last decades or more, attempts to get, regional economic and monetary integration within the continent, talks of a single currency. What are the prospects of a reserve currency emerging in Africa, in your view?
Well, ECOWAS has been pursuing a common currency agenda, the ECO, to reduce barriers to doing business across the region and increasing trade overall. But there are gaps in the required macroeconomic convergence across countries for them to be able to agree to move forward. And with COVID and all kinds of delays, I understand implementation is now tentatively set for 2027. So that's neither here nor there. But analysts are saying the region is to build trust and grow investments first, putting the continent on sounder economic footing, also moving faster with, like you said, opportunities in the Africa Continental Free Trade Pact. That's the landmark trade agreement with a comprehensive scope that includes digital trade, investment protection, and eliminates a lot of the barriers to trade. But having said that, developing nations suffer greatly under the weight of borrowing as they seek to stabilize their economies and prop up the value of the local currencies. The cost of servicing dollar-denominated debt has seriously dented living standard amidst a deteriorating global economic landscape. In Egypt last year, they issued the yuan-denominated debt to raise funding in the Chinese bond market for the first time. So as many are getting more alarmed by the high cost of borrowing in US dollars, many I think are going to shift out of that currency to more maybe the Chinese currency as they borrow more from China so that they can get better stability stability for their own local currencies. But Africa also is importing larger amounts of goods and services from China than any other country, and so it's cost effective to also borrow in yuan and in dollars. My sense is, rather than the move towards an African currency in the medium term, I think what you are more likely to see is shifting in the mix of their reserves more towards China as we get more increased trade and capital flows with China. In the medium to longer term, depending on progress with macroeconomic convergence, the ECO definitely has its appeal, but not in the short term.
Yes, and you make a very good point there, because there's already quite a lot of private trade deals and contracts that are done between African currencies such as the Naira and the Yuan that go on quite a lot. Just another question around the issue of the African continent and regional economic and monetary integration. Of course, the convergence criteria is there, but we've got the cautionary tale of moving towards economic union, as we saw with the UK exiting Brexit, because in the long term, economic interests weren't aligned and potential political interests. With the differing pace of growth across the African continent and the different approaches to monetary policy, there is one commonality, which is many African countries are facing huge levels of debt, and many are struggling to service this debt. And a lot of that comes with conditions from global Bretton Woods institutions like the World Bank and the IMF. Could the debt crisis, in your view, become one of the single largest triggers for the African continent, for instance, to move significantly away from utilizing the dollar as the main form of international trade? I know that might be a tough question, but I wanted to get your thoughts.
Well, I think it would be certainly a consideration, and it's already happening. Just like I said, Egypt is moving more towards China. Of course, South Africa is moving towards China in terms of debt and in terms of its reserves. But you have to be very, very careful. The reason why currencies are put in dollars is so that they can be sure that they're going to have their money back. And because of that, yes, the debt is significant, but it's a problem they have to work out. One thing I must mention, though, the fiscal discipline for African economies, in my view, has significantly improved, despite the fact that, yes, there's a lot of debt. You have to remember that the last 3 years have been extremely difficult. Africa is not like Europe. Africa was already facing a lot of debt and fiscal challenges even before they went into COVID and the slowdown and all the issues. So that obviously made the situation more dire. So I think, yes, these barriers are there, but that should not discourage Africa from integration, from pursuing the Africa Free Trade Pact, and also maybe even their own currency at the right time. The challenges with the EU are really very, very, very different. For Africa, we really need to trade more with each other, significantly more too.
Yes, indeed. And currency convertibility within the region will be key. I want to talk about another region, which I know you have some opinions about. That's Latin America, in the Americas south of the US. What are the dynamics around this issue of de-dollarization? And do you see prospects for moving towards a reserve currency as well within that region?
Well, the two largest economies, Brazil and Argentina, have been talking for a while, but critics have likened this move to opening a joint bank account with an unemployed friend who owes everyone money. That is Argentina. So the idea of creating a common Latin American currency, yes, it was first touted by Gilbert Galipolo. He was an economist working with Lula da Silva, former president of Banco Fato, when he was president from 2000 2003 to 2010. So the silver likes it. And similar to the euro, it would contribute to integration and strengthening the monetary sovereignty of the region. And there are lots of preliminary talks. It's not a new idea. There was 2 decades ago, in 1987, the talk of the gaucho, they called the currency then, but that didn't happen. The reason why these things don't happen, and people talk about them, is because there are issues, and economists are skeptical of a currency plan with Argentina, which is seen as one of the most protectionist economies in the world, with the central bank not as independent as it needs to be, and of course accustomed to price and currency controls. And Rolake, as you know, those are no-nos if you're going to have integration. And most analysts are of the view that yes, intentions are well-meaning. There's genuine problem of dollar shortage in Argentina. There's need for a solution to finding the currencies apart from the dollar. But the whole idea of currency union remains very, very aspirational at best. But Latin America will continue to seek alternative ways of settling trade without using the US dollar. I think, just like we said in other continents, that would mean maybe moving them increasingly towards China.
Yes, indeed. And, you know, the issue of digital currencies is also interesting. I wanted to get your thoughts. There was a story we didn't get time to talk about, which was that a Bitcoin platform whose clients were mostly Nigerians had actually collapsed. But in this whole talk around de-dollarization, what are your thoughts on how digital currency or cryptocurrency might even play a role in this discussion?
Well, indeed, there are countries that have accepted cryptocurrencies, but they are not the more significant countries in financial markets. And my sense is the bank's digital currency, which we thought would pick up. In China, yes, it has. In Nigeria, we have. But you can see that markets have not paid as much attention to it. That just tells you that they're not going anywhere as far as replacing the dollar is concerned. But just like I said, there is a reason why the dollar is the dominant currency. The governance, the robust institutional framework and support for it is something that is going to be difficult to replicate with digital currency and with cryptos, even though it'll always be there. But the more cautious plays would always look at cryptos, for example, as too dubious for them to get into it, despite the fact that they're now being accepted as securities. So these are not easy transitions. When you are running a treasury of a country, where you put the money of the country is a very important decision, and you are not going to play games with it. Yes.
Yes, indeed. Thank you so much, Bode Oshosami, a Rise business analyst, for that amazing deep dive on de-dollarization. Speak soon.